Good morning and welcome. This is 10 years hence. Before we get started, I just want to remind you to silence your cell phones, please. Our speaker this morning comes to us from Chicago, Illinois. Bethany McLean is the author of the New York Times best-selling nonfiction title, The Smartest Guys in the Room, The Amazing Rise and Scandalous Fall of Enron, and All the Devils Are Here, The Hidden History of the Financial Crisis. Ms. McLean is a contributing editor at Vanity Fair magazine. She's also a columnist at Yahoo Finance and a contributor to CNBC. Recently, she's written 2 additional books, Shaky Ground, The Strange Saga of the U.S. Mortgage Giants, and Saudi Arabia, The Truth About Fracking and How It's Changing the World. She's a native of Hibbing, Minnesota, and a graduate of Williams College. Ladies and gentlemen, please help me welcome to the Mendoza College of Business, Bethany McLean.
Hi, everybody. Thanks for being here. So I like to joke that I'm actually the opposite of a motivational speaker. Most people come and talk to people like you and talk about how you can do things right and how you can be a better leader, and I tell these kind of tragic stories of business gone wrong. But I like to believe, actually, that through these lessons of business gone wrong, you can actually learn lessons about leadership and how to do things more right. So the story that probably made my career was the Enron scandal, and it all began back in 2000, and when I started working on the Enron story, and I published a story which I've joked should actually win awards for the meekest title in history, because the story was, is Enron overpriced? And given that Enron was bankrupt 6 months later, I'd say, yeah, Enron was probably overpriced. Anyway, I remember at the time of the Enron scandal thinking that I'd stumbled on this really fantastic lesson, which is that if it seems too good to be true, maybe it is. And I quickly learned after that was a cliche. But I've come to believe that basic lesson does actually lie at the heart of most of these stories of business gone wrong. If it seems too good to be true, maybe it is. And the really uncomfortable thing about that is that belief in something that clearly seems too good to be true requires to some degree the complicity of the victims, the willingness of all of us to go along with that thing that in retrospect is clearly gonna seem too good to be true. And I got some exposure to that when I started my career in journalism, and I've often said I did not set out to be an investigative journalist. I grew up in northern Minnesota, and that thing people call Minnesota nice is a real thing. I am not naturally confrontational, but I started at Fortune magazine in 1995 after having begun my career working in finance at Goldman Sachs. And I got to Fortune, and I quickly got a reputation for being debatably smart, but definitely unable to write. And this was the era of the 1990s, when the first dot-com boom, when everybody wanted to write the story of the CEO turned billionaire, the young entrepreneur who had just become fabulously wealthy by creating this, laundry delivery service online or whatever it was back then that was going to change the world. And nobody was going to let me write those profiles because I had a reputation for being unable to write. So instead, I did the really grungy work that nobody wanted to do, which was the back of the book, as we used to call the back of a magazine, hardcore financial stuff. And I wrote a column called Companies to Watch that was, in essence, a stock picking column. And I was supposed to pick 3 stocks, I think, every 2 weeks, where the stock was going to double or triple or quadruple in value in the next 6 months. And those of you who know something about the market are thinking, wow, if you could do that, you should have gone to make a fortune working on Wall Street. But that's really hard, right? But the thing is, it was actually really easy because there were no shortage of people coming by Fortune, from executives who ran these companies to portfolio managers who owned stock in the companies to research analysts who would buy ratings on stocks. And they would lay out these great little stories from me of these stocks that were going to double or triple or quadruple in value. And they were great stories. I mean, they were really fun. And I'd write them up only to watch in horror as the stock usually went in the opposite direction. And every once in a while, my phone would ring, and it would be somebody in the shadows of Wall Street who would say, basically, you idiot, how did you not realize this thing is a total scam? And it was my first exposure to what I've come to call the buy machine, which kind of defines the business world in some ways. Unlike politics, where people fight with each other with opposing points of view, the business world kind of has this almost wholesome kind of attitude to it, which is if you can't say something nice, don't say anything at all. So the not nice things travel in these very small subterranean pockets, and everybody on the surface just celebrates each other, and that's because all of our interest is in seeing stocks go up. That's where most of us can make our money. So I didn't set out to cover business gone wrong or to write tough stories about companies. I just hated being wrong, and I hated feeling like I was misleading people by putting out a piece that was missing the underbelly, that didn't even attempt to deal with it, that was missing some part of reality. And so people often ask me today, well, don't you want to write about something else other than business? And I branched out a little bit. I did do a Vanity Fair cover story on J-Lo and A-Rod, which is definitely branching out. But I often say about the business world, look, it doesn't get any better than this. Over and over again, business just proves this old adage that truth is stranger than fiction. You can't make up these stories. And there's this other level to these stories too, which is this difference between the surface story and the underlying reality, and this broad notion of this belief in something that seems to be too good to be true. I just read this book about this great American con artist called George Graham Rice, who was in the 1920s in the run-up to the Great Depression. He was known as the Jackal of Wall Street, and the author wrote of the innocents involved, their own willingness to be complicit in a shady deal is what sends them smack into a setup. So in no particular order, I thought I'd share with you my top 10 observations from, horrifyingly enough, over 20 years of covering business, and often stories of business gone wrong. And I share these in the hope that they'll help us all learn how to be a little more right. So another early lesson for me was that stories of business gone wrong are very rarely about bad people setting out to do bad things. They're almost always this mixture of self-delusion, sheer stupidity, venality, greed, but often greed in the surface of ego rather than greed for the sheer sake of money. Maybe a little bit outright corruption, but they're these almost Shakespearean stories of very, very human weaknesses. They add up to corruption in the end, in many cases, but they don't set out with a deliberate decision to do bad things. As a journalist, you only wish you could find that moment where the leaders of the global financial system sat in a dark, preferably smoky room off Wall Street in 2006 and plotted the demise of the global financial system, right? I mean, that would be a great cinematic moment for a journalist, but those moments just don't really exist in these stories. And so one thing I've learned is that just because really smart people believe in something, it doesn't mean they're right. And just because they're a true believer doesn't mean you should be too. When I was really struggling with writing my book about Enron, because I was thinking about Jeff Skilling, who was the CEO of Enron, who just got out of jail recently, I thought, but he believed. He really believed. And how do I write a book about, doesn't that make him innocent if he really believed? And a close friend of mine at the time looked at me and said, Bethany, the worst crimes in human history have been committed by people who believed. So my second book, All the Devils Are Here, which was about the financial crisis of 2008, begins with this story from the bowels of Merrill Lynch, which was, of course, bought by Bank of America in order to bail it out in the fall of 2008 as Wall Street was falling apart. The CEO of Merrill Lynch at the time was a guy named Stan O'Neill, who was a total American success story. He rose from a very poor background to become the first African-American CEO of a major Wall Street bank. But he, like all of us, and I want to reiterate that part, like all of us, had his fatal flaws. And Stan O'Neill's real fatal flaw was insecurity. So slowly but surely, he fired everybody around him who was competent because he was worried that the competent people were somehow angling for his job or trying to take power away from him. And this, over time, had the effect of slowly but surely dismantling really important functions inside Merrill Lynch, namely risk management, which is supposed to keep an eye on how much risk the firm is taking. So picture this: there's this relatively junior risk manager, a guy named John Bright, and he's slowly been pushed aside at Merrill Lynch because he's too competent and too outspoken about what he perceives as the risks. And as we head into the fall of 2007 and people are starting to worry about subprime mortgages, John Bright is getting worried about how much exposure Merrill Lynch really has to these dangerous securities. And he figures out that in the space of a year, the amount of exposure on Merrill Lynch's books has gone from $5 billion to $55 billion. So he does this analysis of how problematic that could be for the firm. Merrill Lynch's third quarter, this is the fall of 2007, is ending in a few weeks. And Stan O'Neill and Merrill Lynch is going to have to report write-downs, and they're telling the market they're going to write down maybe a couple $100 million in losses. And Stan O'Neill gets wind of John Bright's work and calls him into his office and asks him, well, how bad do you think it's going to be? And Bright says to him, well, $6 billion, but it could be a lot worse. And Bright said he'd never forget how Stan O'Neill looked in that moment. It wasn't, oh, I've been caught, somebody's figured out what I've done. It was total shock, looking like he'd been kicked in the stomach. And Bright realizes at that moment that Stan O'Neill seemed to have no idea that it was his own actions that had totally dismantled and undermined Merrill Lynch's risk management function. And so when the meeting is finally over, Bright says, I hope we can talk again. And Stan O'Neill says, I don't know. I'm not sure how much longer I'm going to be around. And indeed, he's fired as the losses begin to escalate at Merrill Lynch and everywhere. And John Bright walks back to his desk with this very strange realization that he's this lower level employee who's totally out of the loop. And he's just informed one of the most powerful men on Wall Street that the party is over. So a second lesson for me is that incompetence is often more destructive than outright malevolence. And you really can't overestimate the amount of incompetence in the world. When you look at the financial crisis, Merrill Lynch knew more than, Wall Street knew more than anybody else how these securities made out of subprime mortgages were being constructed and what was happening to the dangerous pieces of them and exactly what kind of garbage was going into the making of the sausage. And yet, Wall Street famously loaded up its own balance sheet with these bad securities, and that's why so many firms almost ended up going under. And John Bright actually said to me at one point when I said, "Well, how could that have happened? How could Wall Street have loaded its own balance sheet up with these securities?" And John Bright said to me, "We fell for our own scam," which I thought was an awesome line. Anyway, for years this belief that big institutions were too smart to do stupid things it ruled our system. Alan Greenspan, the former and once revered chairman of the Federal Reserve, was a fairly hands-off regulator, and the Federal Reserve has a couple of functions. It obviously regulates monetary policy, but the Federal Reserve is also supposed to serve as a regulator of the nation's biggest banks. And he really believed that banks just wouldn't do anything stupid because it just wasn't in their interest to do so. And that's part of the reason that the Federal Reserve didn't rein in subprime lending in the run-up to the crisis. Greenspan just didn't believe that banks would put on their own balance sheet loans that had been made to people who couldn't pay them back. He thought they were simply too smart to do that. At least he used to think that. In 2008, after the crisis, Greenspan testified to Congress, "Those of us who have looked to the self-interest of lending institutions to protect shareholders' equity, myself included, are in a state of shocked disbelief." So if you think about Enron, the title of the other Enron book, and there was another Enron book, there were actually a bunch of other Enron books, was Conspiracy of Fools. And it was a really good title. Of course, Smartest Guys in the Room, the title of my book, meant in a very ironic fashion, is a good title too. But in the end, if Enron had been able to run businesses that made money, they wouldn't have had to resort to tricks that made it look like they were making money when they weren't. And so I'll pause really quickly on Enron and what the problems there were, and just because it's such an instructive lesson in how not to believe the surface story and why to dig into the numbers. So in 2000, Enron was viewed as a superstar stock. Every analyst who covered it had a buy rating on the stock. The price targets were double where the stock was trading. I think the stock had gone up 90% in the year 1999. Consultants from McKinsey ran around the globe preaching to other executives how they could make themselves more like Enron. They used to call the Enron executives petropreneurs. So I decided just another little red flag when McKinsey consultants are coining words. watch out. Anyway, and I remember a source of mine coming to me and saying, well, we can't figure out how Enron makes its money. Really basic question, right? And a question that was totally at odds with this exalted reputation. And I called one of the rating agencies analysts who covered Enron, who was responsible for telling the market essentially how likely it was that Enron could pay back its debt, and they rated Enron investment grade, meaning it should have no problem paying back its debt. And I said to this rating agency analyst, well, how does Enron make its money? And he started laughing, and he said, well, let me know if you figure it out. But then he went on to say that you really didn't have to worry about this because these guys were the smartest guys in the room, and they were so brilliant that you really didn't have to pay any attention to the messy details because they were just gonna be great. If you looked at the messy details and you read the financial statements, you saw a bunch of worrying things like earnings that went in a straight, beautiful, ever-increasing line upwards, but negative cash flow from operations. And for those of you who are finance-oriented people in the audience, when there's a huge diversion between earnings and cash flow, it's not always a sign of a problem, but it's a red flag and warrants further inspection. And there were these disclosures in the footnotes of these strange off-balance sheet partnerships that were being run by the company's chief financial officer that did all their business with Enron. And think about how incredibly odd that is to have an outside entity run by the company's chief financial officer that does all of its business with the company itself. And if you tried to make heads or tails of what actually was being done between the company and this related party, it was written in such a way that you absolutely couldn't tell what was happening. So under the beautiful surface of these guys are so smart, you don't need to pay attention to the detail, lurked some incredibly ugly details. So the next lesson for me is on the unreliability of models, and let's call it the garbage in and garbage out rule. I did a piece, I guess it was 2 years ago, in Vanity Fair on Wells Fargo, which, as you all know, has been bedeviled by this fake account scandal in which junior people at the company were gaming the rules and outright committing fraud in order to open fake accounts to clients for customers because their continued employment at Wells Fargo depended on hitting a certain number of sales goals. And what struck me the most about this story is that Wells Fargo should have known they had a problem. The scandal erupted into the public in the fall of 2016, but it was actually back in 2013 the Los Angeles Times wrote about the fake account problem, essentially giving Wells Fargo a heads up. You guys have a massive problem inside your firm. And of course, if Wells Fargo at the time of the Los Angeles Times story had gotten all over this problem, they would have fixed it long before they were in the state where they are today. But when John Stumpf, the then CFO of Wells Fargo, read this Los Angeles Times piece, and Wells Fargo did some work, Stumpf came away relieved, not worried. And the reason he was relieved is that the company's internal analysis showed that only 1% of its workforce was being fired for these issues, for creating fake accounts. And he said, 1%, that's great. We're terrific. Look at that number. But if you actually thought about the 1%, it was a completely meaningless figure. And it was completely meaningless because Wells Fargo's sales force had turnover of 30 to 40% a year. So it didn't capture why all those people were leaving and what they might have been leaving for. The 1% was only a measure of the people who got caught. It wasn't a measure of the people who might have been engaged in this behavior. And it certainly wasn't a measure of where the pressure in the company to engage in this kind of behavior was coming from. And so he took refuge in a number that in the end was completely irrelevant. And I think about that a lot because in a world that is ever more complex, we all love to take refuge in a model that offers the illusion of truth, but it's not really truth. And you can see that at work in the financial crisis as well, where everybody on Wall Street relied on a model called value at risk, which goes by the shorthand of VAR. And VAR purports to measure how much money you can lose on a given trading day. And the VAR models all showed Wall Street firms that they weren't going to lose very much money from subprime mortgage exposure. And they all believed the models. They all took refuge in the models because they wanted to, and because as Wall Street has become increasingly complex and people at the top of the firms no longer really understand the nitty-gritty of what's going on in the trading floor, they don't understand the fallibility of the models. They can only see the number that's spit out at the end of the model, not the messiness of the inputs. And so it's no accident that the one firm that in some ways got the financial crisis right by attempting to dump its subprime mortgage exposure on its customers, namely Goldman Sachs, was the one firm where the top executives had been traders and understood that the models could lie. And in the fall of 2006 said, despite the fact that their models were still showing them that there wouldn't be losses, said, the models are no longer right. We're not going to rely on these. We know what the market is telling us. And so I think it's a really good rule to keep in mind. Old simplistic rule, garbage in, garbage out. If you're using the wrong inputs, it really doesn't matter what the answer was. And it's something to really worry about in today's world because it's only becoming more complex, right? And so the desire to rely on the apparent simplicity of models is just becoming more and more tempting and more dangerous. Another lesson I think about a lot is what I like to call the dog and the duck. And I call it by another term that I invented, which is legal fraud. And let's go back to Enron as our example. A lot of people today think of Enron as a gigantic fraud, but it really wasn't. Much of what they did, including these partnerships that the CFO ran, were actually technically legal. The accountants had signed off on them. The lawyers had signed off on them. It was a very difficult case to prosecute, in part because so much of what they did had met the letter of the law. And you can see that in the fact that Enron went bankrupt in the fall of 2001, and it wasn't until the summer of 2004, maybe 2003, but I think 2004 that Jeff Skilling was indicted. And you can see that it's a very complex case if it took multiple years after the bankruptcy for the top executives to be indicted. And that's because so many of Enron's individual transactions met the letter of the law. If you added them all up, you got a company whose financial statements completely misrepresented economic reality. So it was a fraud. Its financial statements misrepresented economic reality. But when you drilled into the details, very hard to say where the fraud actually lay. And you can see one explanation for this in what Enron wrote in its risk management policy, and I'll see if I can read it with a straight face. They wrote this: reported earnings follow the rules and conventions of accounting and are not always in accordance with economic reality. Management is judged on reported earnings. Therefore, risk management strategies are aimed at reported earnings, not economic reality. I mean, think about that for a little bit. So back to the duck and the dog, one of Enron's accountants explained the same principle to me this way. He said, say you have a duck and a dog, and you want to make the dog look like a duck on the financial statements. So you take the dog, you paint it white, you give it, I don't know, whatever kind of feet a duck has, those little webby feet. You stick a plastic beak on its nose, and you hand it to your accountants, and you say, look, it's a duck. Everyone can look at it and see that it's a dog, but technically you've met all the rules for calling it a duck. So the accountants say, yep, a duck it is. And that's how it goes on the financial statements. So we saw a similar story play out a couple of years ago with Valiant Pharmaceuticals. I don't know if you guys are familiar with the Valiant scandal. There's a great episode, a Netflix show called Dirty Money, about what happened with Valiant. And Valiant was basically a company run by another alum of McKinsey, just like Jeff Skilling, a guy named Mike Pearson. For those of you who work or are going to work or have worked at McKinsey, no disrespect intended, or maybe that's not true. Anyway. But so Valiant made, essentially its business model was taking drugs that people needed to save their lives and jacking up the price on those drugs as far as they possibly could, under the theory that people would pay and insurance companies would pay because they had to, because there was no other option. As I first got interested in Valiant, I'd been following it kind of loosely, but a friend of mine suffers from a disease called Wilson's disease, which is this rare disease where copper builds up in your body, and if you don't take a medicine to get the copper out of your body, you'll die. You'll die of liver failure. And she took a medicine called Cyprine, and she paid, the medicine cost roughly $1 a day for years. It was super cheap. Valiant bought it and jacked up the price to over $300,000 a year. And my friend had insurance that paid for it, but she was panicked about what would happen if her company, she had retired, if her company stopped paying for her insurance, if the company went bankrupt. She would be dead within 5 years because she was unable to pay for the medicine. Her sister was stuck in a job she didn't really like and would have loved to have switched, but she couldn't take the risk of losing her health insurance with the price of her drugs skyrocketing. And on another level, that just shows the fallacy of this argument that of rising drug prices, that, well, somebody else pays for it, and if you have insurance, it doesn't matter, because in the end, we all pay for it. But anyway, one of the shocking things about the Valiant story is that, once again, what they did was legal. There's no rule against a company acquiring a drug and jacking up the price as much as it can. There used to, in the old days, be kind of an ethical speed rail that would have prevented that, but in the modern economy, that's gone. I remember in the Valiant, in the documentary, in the Dirty Money documentary, Senator Claire McCaskill says on camera, we didn't find anything they were doing which was illegal. So another thing I think about is a synonym for magniloquent. So ask any venture capitalist in Silicon Valley, and they'll tell you usually that the more ornate the pitch deck is, the more complicated it is, the weaker the company is. The more adjectives somebody uses, the more they might have to hide. And I've begun to think the same is actually true of corporate codes of ethics and corporate culture statements. The grander the words, the more earnest their promises, the more potential there is for problems. Enron had the best code of ethics I've ever seen. I wish I had it here with me because it actually has this beautiful red rose on it. It's very, very pretty. And in their case, their flowery language was marvelous. This is my favorite part. We treat others as we would like to be treated ourselves. We don't tolerate abusive or disrespectful treatment. Ruthlessness, callousness, and arrogance don't belong here. But the reality of Enron was the exact opposite. People were paid and valued for the short-term earnings they could create, no matter who they stepped on in order to reach their goals. I think you could point a finger here again at Wells Fargo, too. In 2012, before the fake account scandal broke, Forbes did a big profile of the company and of John Stumpf, and the title of the profile was "The Bank That Works." And here's what Forbes wrote. It's a monumentally larger version of the critical scenes in It's a Wonderful Life. And Wells Fargo even has its own version of George Bailey, Jimmy Stewart. CEO John Stumpf, who spins out the kind of corny homespun sayings you might find embroidered and framed on the wall of Aunt Tilly's lake cabin. He says, this is quoting Stumpf directly, "When we hire somebody around here, we want to know how much you care before we care how much you know." It wasn't long before the truth came out about what had been going on at Wells Fargo. But it wasn't only the sanctimonious veneer, of course, at Wells Fargo that caused problems. It was their pressure to deliver results that pleased the market. And I think of all the sins in American business, the one that causes the most problems is the pressure cooker of short-termism. And the funny thing about this is that we've been talking about this the dangers of this since I've been covering business, literally since the days of Enron, and it just doesn't seem to get any better. Only about a year ago, Warren Buffett and Jamie Dimon, the CEO of JP Morgan Chase, came out with a plan to address the pressures of short-termism by having companies stop announcing quarterly earnings results. I'll never forget talking to Angelo Mozillo, the former CEO of Countrywide, who many people think is one of the chief villains of the financial crisis. His company spread these toxic loans across America. But just as an aside, back to this notion that this isn't bad people setting out to do bad things, this is not what Angelo Mozillo set out to do. He didn't set out to bring the nation's financial system to its knees by selling people toxic mortgages. He was the son of a butcher who grew up in the Bronx and was very much a self-made man and always had a chip on his shoulder because he felt that he was looked down on for being Italian-American in the days when Italians couldn't get jobs on Wall Street and for having gone to Fordham instead of gone to an Ivy League college. And he called his company Countrywide his baby because he took such pride in this company he had built. And he said from the very beginning that he wanted his baby to be the largest mortgage originator in the country. And you can almost view that the entire Countrywide story then through this lens of this grand desire to be the largest mortgage originator in the country, tied to short-termism gone wrong. Because as bad loans started being made by shoddy mortgage brokers, Angelo Mozillo didn't want to risk losing market share to these companies, and he felt like he couldn't because his board of directors and his investors would have said, "Why aren't you getting these earnings? Why are you losing market share to these other companies?" And so he and Countrywide embraced what they called the supermarket strategy, which was this idea that if a shoddy mortgage originator down the street was making any mortgage, Countrywide would offer a mortgage on the same terms. So they didn't risk losing market share to the shoddy mortgage originator down the street. And that, of course, in retrospect, it's clear. It had the effect of taking these really bad loans and propagating them around the country at a scale that only Countrywide could have pulled off. But Mozilla told people after the fact that if he hadn't done this, he probably would have lost his job due to pressure from his investors and pressure from board members not to lose market share. And the sad thing is that he has a point. McKinsey recently surveyed more than 1,000 corporate level executives and board members around the world, and 65% of them, almost 2/3, said that the pressure to generate short-term financial results had actually intensified in recent years. And the overwhelming majority of these companies felt significant pressure to show financial successes within 2 years or less. I was actually giving a presentation with Andy Fastow, the former CFO of Enron. We can come back to that, don't even ask, or maybe do. But this fall, and Fastow pointed to a Wall Street Journal headline that was really interesting, and it was about how chief financial officers were having their bonuses tied to the financial results they were able to deliver. And Fastow pointed this out. We're all so used to this idea that there's this pressure to deliver financial results that, to be honest, I hadn't even paused on the headline. And Fastow pointed out, what should a CFO have to do with generating the financial results? A CFO is supposed to report the financial results that the business has generated, but they're not supposed to have any influence over what those numbers actually are. And the mere fact that we all just take this for a given and shrug our shoulders at it shows how accepted this notion of the pressure to deliver results has become. So a sort of corollary to this is this idea of gambling in Casablanca. Like, tell me it isn't so. And so just because behavior is known and accepted today doesn't mean it's going to be that way tomorrow. The mood of the public, the press, prosecutors can switch on a dime, and today's hero can be tomorrow's pariah. Most of you in this room probably weren't around back in the 1990s, but there was this giant scandal involving Wall Street analysts that came out in the wake of the collapse of the first dot-com boom. And it turned out that Wall Street analysts were putting buy ratings on stocks they knew were garbage. They were some of the very ones I fell for when I was writing companies to watch. But they were putting buy ratings on stocks they knew they were garbage because it would help their firms collect investment banking fees, and you could make a lot of money from those investment banking fees. But the funny thing is about this scandal is that everybody knew it was happening. There were even jokes among those of us who covered it about what a strong buy rating meant, that a strong buy rating meant maybe buy, and a buy rating meant run for the hills, because we all knew it was a joke. And Eliot Spitzer, who before the scandals he became better known for, was the very fierce Attorney General of New York, went after this practice and ended up finding Wall Street firms hundreds of millions of dollars. And it was, we're shocked that this behavior is happening, but we weren't. We all knew it. It's just when somebody finally looked at it through a different prism of people having lost fortunes in the wake of the collapse of the internet bubble, suddenly behavior that had seemed somehow acceptable came to see what it really was, which was reprehensible. Look again at Valiant, the high-flying drug company. I remember it was actually in the wake of do you guys know who Martin Shkreli is? Most of you probably do, right? So I did a piece on Martin Shkreli, who had famously jacked up the price of this drug called Daraprim by 3,000% or some astronomical number. And he was just excoriated roundly for what he had done. But meanwhile, other companies like Valiant were doing exactly the same thing. And I remember sitting with an investor in Valiant and saying, why is what Martin Shkreli did any different than what Valiant is doing? And the guy looked at me and shrugged his shoulders and said, that's a really good question. But it actually wasn't until a year later when Congress started holding hearings on what Valiant had done that investors in Valiant stock, who had known full well how Valiant was making its money, most notably the well-known hedge fund manager Bill Ackman, testified in front of Congress, we didn't know that raising prices was part of their strategy. They knew all along. They just didn't think they had to care until the moment when they did. So I think a corollary to this is just because every scandal requires the complicity of the victims, and maybe therefore in some ways the blame should be shared, it doesn't mean that when the story gets told, the blame actually will be shared. Our narratives tend to become extremely one-sided, in part because we're always looking for the villain. Life seems clearer and easier if you can find the villain, the one person who did this to us and who caused all the problems. I think something else I think about, and I see this a lot, is the cult of personality. It was certainly true of Valiant, where people used to refer to the CEO, Mike Pearson, as Mike. And one investor said to me, anytime you have a company where people are calling the CEO by his first name, you know that it's no longer an investment, it's a cult. And I think we can point to many other companies today where that's true. But there are so many examples of these super smart analytical investors disregarding the numbers, disregarding the evidence that is in front of them because of their belief in the person. The cult of personality is a very real thing. And there are ways in which CEOs can magnify that. And I think back to Jeff Skilling, who I think is incredibly instructive in some ways. Skilling had this division of the world into people who got it and people who didn't get it. And everybody wanted to be on the list of the people who got it. Nobody wanted to be on the list of the people who didn't get it. And if you asked a question that Skilling didn't like, that was too probing, he would just say, you don't get it. Nobody wanted to be included in that list. And that had the effect of having very smart people pretend that they got it because they didn't want to risk looking foolish and didn't want to risk being publicly put in the group of those who didn't get it. And for those of you who are young in this room, you say, oh, well, as I get older and more confident, I'll of course be more willing to say that I don't understand. The very funny thing about life is that it actually works in exactly the opposite direction. And I think the reason is that the older you get, the more you have to lose, and the more afraid you often are of looking foolish. And so the more afraid you are to say, I don't get it. And the reality is you might actually look foolish. You might be the one person who really just doesn't get it. But it's why this life lesson of the emperor's new clothes, it's the little child who says the emperor is actually naked, remains incredibly true. Skilling had another trick that I always try to keep in mind, which is what one person told me. Back to McKinsey again, sorry, but the McKinsey data dump. And you'll see if you start listening for this, that it's a way people have of answering questions they don't want to answer. They don't actually answer. They just give you an enormous amount of data. And you think if you can't stay with the data that's being thrown at you, and most of us can't, you think, well, the answer's got to be in there somewhere. I just didn't hear it, so I'm just going to say okay, because I probably just didn't keep up with the answer, and it's somewhere in that giant pile of information. I do this today. For me, the only marker of intellectual honesty is when I sit down to try to write, and I realize that I actually didn't understand what I was told, or that the answer to my question isn't in all of the data I just got. But it's really hard in real time to actually stay with that, and to try to keep in mind that you didn't actually get your answer. And so if I have one little life tip, it's come up with your own method for figuring out that you didn't get your answer, whatever it is. It doesn't have to be calling somebody on it in real time if you're not aggressive personality. It can just be your own private method of acknowledging to yourself after the fact, I didn't actually really understand that. But try to develop that honesty for yourself. My new book is about this guy named Aubrey McClendon, who wasn't the father of fracking in the sense that he wasn't the guy who technologically figured out how to get oil and gas out of places in the earth that had never yielded it before. But he was the salesman, who got investors around the globe to commit literally hundreds of billions of dollars to the fracking industry. And if anybody's curious, we can come back to why that industry is so problematic on a financial basis. But there's some stunning numbers about McClendon that I calculated. From 2001 to 2012, his company, Chesapeake Energy, raised over $15 billion in debt and over $15 billion in equity, and raised another $30 billion, so well over $60 billion. Then the other 30 came from kind of these Enron-esque financing deals that they came up with and through asset sales. Over $60 billion, and never in those years produced free cash flow, which is arguably the most relevant measure of a healthy business. But he was such a good salesman about the fracking revolution. I sat down with an analyst at an investment firm when I was in the early stages of reporting my book, and this analyst was skeptical about McClendon and skeptical about the whole fracking industry. But he still said to me, I never let Aubrey McClendon in here for a meeting because I knew if I did, we would have bought a ton of stock and it would not have ended well. And it did not end well. Aubrey McClendon was indicted by a federal grand jury for rigging bids in the spring of 2016. He died in a car crash the next day. One of the great mysteries is whether it was an accident or whether it was suicide. And Chesapeake, his company, now sells for less than $5 a share. So something else I think about is visionary or fraudster. What really is the line between being a visionary and a fraudster? What's the line between being a disruptor and just being disruptive? I don't know the answer to that fully, but I usually think about this, that most people think of the visionary and the fraudster as being on opposite ends of a spectrum, with the fraudster here and the visionary here. I actually think they're where a circle meets, and the line between the two is much finer than most people would ever admit. And the reason, and sometimes I even think it's worse than that the visionary is simply the fraudster who didn't get caught while in the midst of the fraud that ultimately worked. And what I mean by that is that some of the characteristics of the visionary and the fraudster are actually the same. The unwillingness to take no for an answer, the rabid belief in your own ideas, the refusal to listen to skeptics, the willingness to tell little lies because you feel like if you actually tell the truth, then maybe you won't be able to get the deal done, and you need this deal to survive and fight for another day. If any of you have seen the new Theranos documentary, The Inventor, the filmmaker begins at the beginning with Edison, who actually lied about whether his light bulb worked right up until the very moment when he had to roll out his light bulb. And by then, miraculously, he had gotten it to work, and he actually had a product. But up until the moment of the unveil, he actually didn't have a working product. He was lying and telling people he did. What if he had gotten called on it a year earlier? He would be regarded as a fraudster rather than as a visionary. I think it's a really interesting lens to think about your own life if you want to be an entrepreneur, as well as the business world writ large. Valiant now is struggling to survive, but one reason that investors were so drawn to Mike Pearson, the company's CEO, is that Pearson was viewed as a disruptor, as a visionary, as a person who was going to remake the pharmaceutical industry as a more effective capitalistic machine. Pearson was nothing like your beautifully dressed, smooth-spoken, suave CEO. He was incredibly messy and dirty and had a drinking problem. And so investors therefore thought that he was a truth teller, that he was an iconoclast. One researcher told me the business model was pitched as, the rest of the industry is stupid and we are smarter than everyone. And that's very appealing to people who also think that they're smart. So when Pearson was trying to convince shareholders to vote in favor of an acquisition he wanted to make, he actually gave out copies of a book called The Outsiders by William Thorndike. And the book celebrates these outsider CEOs, these mavericks who have done things differently. But it turns out that Pearson was lying about some of what actually drove the business's success. I think the author of the book about Theranos knows more about it than I'll ever know. But I think I'd add a note here about Elizabeth Holmes, the founder of Theranos. And perhaps one takeaway from this story is that when a CEO tells you that her business, and I do like the fact that I've got one woman on this list of villains in my litany of frauds. I'm hoping we get more. I think that will actually be a mark of success. But when a CEO tells you that her business is the most important thing that has ever existed in the entire world, be very careful, because there's a very fine line between inspiring people with your grand beliefs and using your grand beliefs in order to justify lies. So on a last sort of note and lesson, I wanted to talk about this idea that, is it really good to be the king? It's kind of more of a life lesson than a business lesson, although it extends into a little bit of pattern recognition. We all know that life is hard at the top, but just how exacting is the toll for the individual? And I think it's a good reminder that we're not all just the sum of our work, and perhaps it's a real danger sign and a red flag when an executive starts to talk about that toll. In a Texas Monthly interview with Jeff Skilling, just a few months after he had departed from Enron, Skilling complained about his life and everything he'd given up in order to run Enron. He said, "I just had no idea of what I'd let go of," referring to all the personal sacrifices he'd made. He said he was divorced. He'd almost missed his brother's wedding. He never took his youngest son to school. He said, "I'm interested in the kids, but you don't do kids in 15 minutes. And he finally said, "I'm not sure that fulfillment in life is compatible with a CEO's job." So I was struck by the parallels between Skilling and a New York Times interview last summer with Elon Musk. Speaking of visionaries and fraudsters and larger-than-life personalities and all sorts of things along those lines. Anyway, the title of the story was "Elon Musk Details Excruciating Personal Toll of Tesla Turmoil." And the New York Times wrote, "He choked up multiple times, noting that he nearly missed his brother's wedding." I thought, oh my goodness, you just can't make this up in terms of pattern recognition. Anyway, and spent his birthday holed up in Tesla's offices as the company raced to meet elusive production targets. He said, there were times when I didn't leave the factory for 3 or 4 days, times when I didn't go outside. This has really come at the expense of seeing my kids. Anyway, so Jim Chanos, a well-known short seller, likes to talk about pattern recognition is one of the key things that he looks to. And if you're looking for pattern recognition, I think that one is pretty creepy. So just to come back in closing to this idea of truth being stranger than fiction, there's another quote from Mark Twain that I absolutely love, and it's that the difference between fact and fiction is that fiction has to make sense. The first Vanity Fair story I ever wrote was about a guy named Henry Nicholas. And he was the billionaire founder of a revolutionary chip company called Broadcom, which really came into being in the late 1990s and early 2000s. He was indicted in 2008 for stock options backdating. And you guys are thinking, stock options backdating, Vanity Fair story? Doesn't sound likely. He was also indicted for essentially running a drug ring. A little more Vanity Fair, right? It came out after his indictment that contractors he had hired to, according to a lawsuit, contractors he had hired to build a lair under his house where he could do drugs and see prostitutes and keep it a secret from his wife. Okay, very Vanity Fair, right? Anyway, but it struck me then, as it does now, as a perfect metaphor for what secrets can lurk beneath the smooth facade of a successful business. But it also proves to me this old adage of truth being stranger than fiction again and again. You just cannot make this up. The same thing with the financial crisis. I remember as problems started to brew in the subprime market, one person said to me, this isn't going to end until a Wall Street firm is bankrupt. And I remember looking at them and thinking, well, A, I've seen my scandal. That was Enron, and there won't be another one, not like that. And B, look at these firms with their shiny, magnificent, 50-story headquarters in Midtown Manhattan. They're not going bankrupt. They're not going away. That can't possibly happen. But of course, it did. And so I ended my Henry Nicholas story with this quote from Calvin and Hobbes that I love. And Calvin asks, do you believe in the devil? A supreme evil being dedicated to the temptation, corruption, and destruction of man? Replies Hobbes, I'm not sure that man needs the help. So on that note, I just wanted to conclude on the note that I'm not a hater of business. I'm actually a massive believer in business done right as an engine of positive change in the world, change that creates products and services that people need, that creates livelihoods for families, that creates economies and communities. I get very angry at business gone wrong because it is such a waste and because the costs are so high. But it's the flip side of my deep respect for business done right. So on that note, I wanted to open it up to whatever questions you all have. Go ahead.
Thank you very much for coming, first of all. So if every step of the way Enron and Valiant was acting in a strictly legal sense, where is the onus for policing them? Should it come from within the company or increased regulation?
Right.
It seems like somehow someone kind of fouled up here.
Right.
And it's tough to say where, obviously, but what do you think?
Right. It's a good question, and I shouldn't overstate it. There were places where Enron did cross the line, and that's why executives ended up serving time in jail. And I think that's the danger. Even if you put aside the ethics of it, that's actually the danger of a strategy that plays right up against the limits of the law, is that it almost becomes inevitable that you're going to step across those lines at some point and in some way. It's just that defined in strictly legal terms, the Enron fraud was much more narrow than most people think it was. I'm actually going to tell a quick story on that note because it's instructive. At this criminal trial of Jeff Skilling, he testified. Unlike most people who are accused of a crime, he actually testified. And the jury went from being very skeptical of him to almost eating out of his hands because he is very intellectually charismatic. And you could tell they were starting to believe him. They were nodding in agreement with him. And Skilling had sold about $15 or $20 million of stock on, I'm going to be a little bit wrong about the dates, but directionally right. I think it was September 16th 16th that he sold his stock. And he testified to the Securities and Exchange Commission that he had only sold his stock because of 9/11, and that was his belief in Enron was absolutely pure, but he was really worried about his company and his own financial well-being after 9/11, and so that was the only reason he sold his stock. And the SEC pushed and said, "Did you really? That's it?" And Skilling said, "Absolutely." So it came out at trial that he had actually called Charles Schwab on September 8th or 7th trying to sell his stock. And Charles Schwab, the representative at Charles Schwab, and this was on tape, said to him, you're still an officer of Enron, we have to disclose this. And Skilling said, "No, I'm not, I quit. You don't have to disclose that I'm selling the stock." And Charles Schwab said, "Well, you need to get me paperwork to show you're not still an officer of Enron." So by the time Skilling got the paperwork to Charles Schwab, it was after the close of the market on Friday, September 8th. And the market obviously didn't open on Monday, September 11th, and didn't open for the rest of the week. So by the time the stock sale was executed, it was the 15th or 16th. So Skilling tried to use our nation's tragedy as an excuse as a cover for his stock sale. And I'm still not sure that he would have been convicted if it hadn't been for that moment, because talking about the switch in perspective and how the lens can change, it was suddenly this moment of, who is this person? But anyway, that was a tangent. So back to your question, I think it has to be a genuine moral belief at the company, a belief in reality as well as artifice. In other words, if you're using the rules and using all the loopholes in the rules in order to manipulate the appearance of reality and forgetting about the principle of honesty, then you're going to end up in trouble at some point. And I do think it has to be this real belief and commitment to the long term. So another quick story, one of the few nice stories I've done was on Warren Buffett, and I got to go spend a day with him in Omaha. And Buffett said to me at some point that the most important thing to him was that his company, Berkshire Hathaway, was around in 100 years, because it's an insurance company in part, and it's made promises to pay people that stretch out for 100 years. And it would just be devastating to Buffett if the company weren't able to meet those obligations. And I thought, if everybody ran their businesses with that idea that this company has to be around in 100 years, we would have a very different business world. So I think that's where part of the answer lies. I'm not a huge believer in the answer lying in regulation. And the reason why is that clever people can use the rules, just as Enron did, as the art of the possible, and find the loopholes in the rules that permit them to manipulate the rules in ways they were never supposed to be manipulated. And I think, one, if you want to be cynical about regulation, you can look to the wake of the Enron crisis, when George W. Bush, president then, signed in the Rose Garden legislation known as Sarbanes-Oxley. I think it was in 2004. And he stood in the Rose Garden saying, "The world is now safe for individual investors. Corporate malfeasance will no longer be allowed. Everything's great and will only be rosy from here on in." It was, a few years before the financial crisis erupted. And then in 2010, you have President Barack Obama standing in the Rose Garden signing legislation known as Dodd-Frank. Speech is very similar. The world is now safe forever. Corporate malfeasance will no longer be tolerated. Individual investors can be sure that they're on equal playing field with large corporations. It's really disheartening to look at the speech, and it's no knock on regulation. Regulators are people too, right? And sometimes being able to see how companies will use rules and how companies will get around rules and how the business world will change such that the rules that were written are totally irrelevant is just beyond anybody's grasp. I see a hand all the way up there. Yeah, so I'll answer this question in two parts, because back when I wrote about Enron, it was 2001, and the world of journalism was a really different place. I worked at Fortune, which at that time was part of a magazine empire known as Time Inc., and it had a lot of resources. It wasn't as wealthy as corporate America, but it had a lot of resources. And so I did get a lot of backlash. Enron pushed back pretty viciously against the story being published. They flew 3 executives to New York who tried to argue me and my editors out of the story. Jeff Skilling told me that if I wrote this story, I was unethical because the questions I was asking were so stupid that they showed that I didn't know enough about the company to write this story, because if I did, I would be asking, if I'd done my homework, I would be asking better questions. And that's a really scary thing to be told, because it could always be true, right? Even if you've done a lot of work, you could actually be missing the point. And Ken Lay, who was then Enron's chairman, actually called my editor and requested that the story not run, or that I be fired. But you know what? I didn't even find out about that phone call to my editor until after Enron had gone bankrupt, because that was the structure of the world at the time. Journalistic organizations had enough power and resources of their own and enough sort of history of standing behind reporters that it was different. I think it is much trickier today because most journalistic organizations are much shakier financially, and the fact that people are still doing great work against powerful forces in the face of that is actually pretty remarkable. But the pressures are extreme today, and so I don't take for granted the kind of support that I got back when I wrote about Enron. There are a few institutions, journalistic institutions, that still offer their reporters that kind of support, but it's not as, you can't take it for granted the way you once could.
During the presentation, you mentioned why fracking is dangerous on a financial basis. I was wondering if you could elaborate on that point.
Sure, thank you for asking. So the thing that made me write my little book called Saudi America was this sort of discord, or this disconnect between these two ideas, both of which are true. One is that fracking is changing the world, and it really is. I mean, 10 years ago, there were widespread fears of American oil shortages and shortages of natural gas. That was the way the world was supposed to be. Now we are the world's largest producer of oil, bigger than China and bigger than Russia and Saudi Arabia for the first time since the 1970s, and there's this belief that we have enough natural gas to last us for hundreds of years. And that's a direct result of the fracking revolution. There's this idea that it's transforming geopolitics, which I think is more of an idea than it is reality right now, and we can come back to that. President Trump even talks about, presidents since the 1970s have talked about American energy independence. President Trump talks about something larger, which is American energy dominance. But the truth is that the fracking industry doesn't make money and never has. It doesn't produce free cash flow. And so putting aside the environmental issues of fracking, there's this very real financial industry, which is that the industry does not work on a financial basis. And so in my book, I actually track the fracking revolution directly to the financial crisis, in that in the wake of the financial crisis, the Federal Reserve slashed interest rates. And so for companies that need an enormous amount of debt, it became much more feasible to raise that debt. And that's what fed the real catalyst. I quote an academic saying the real catalyst of the fracking revolution was actually the Federal Reserve in this era of unprecedentedly low interest rates that it's ushered in. But through the years that fracking has been in existence, whether oil's been well over $100 a barrel or under $100 a barrel, the industry has never made money on a free cash flow basis. And so in a sense, it's a Ponzi scheme that requires a constant influx of new capital in order to keep production growing. And I think it's actually less a financial risk than it is almost kind of an existential risk, in the sense that right now everybody is betting on just huge growth in American oil to keep prices low. And what if the capital dries up? And there are signs that it is drying up. The public markets are no longer willing to finance fracking companies because investors are tired of the lack of returns. What does that mean for production numbers? If companies have to only be able to invest the cash flow they can produce, and they can't constantly be raising these hundreds of billions of dollars of new capital to put into the ground, what happens to production levels? And therefore, what happens to the supply of oil, and what happens to oil prices? And so I think it's a big question. You're welcome. Anyone else? I see one right there. Go ahead.
To your concluding point, it seems that often business done right evolves out of business done wrong, like with that Thomas Edison example, how the light bulb didn't work until the very last minute. Can you kind of comment on the fine line between the two?
Yeah, I struggle with that because I think it's a really interesting question, right? I mean, there are two ways to think about. There's business done right in just a very standard, straightforward way of running a business, which I think doesn't involve that. But I think if you are going to be somebody who changes the world, and the world moves when people who like risk take action and try to do big things, then I think you do get into this fuzzy line between how much slipperiness will we permit. And the reality is when we look back on something that was a little bit slippery, if it all worked out in the end, we say, oh, wasn't that cute? If it didn't work out in the end, we say, that was fraud. And so much of of how we classify things depends on how it turned out, not actually by what actions were undertaken. If you read Ashley Vance's book on Elon Musk, you see the first half of that book is incredibly good, and it shows the number of very slippery things that Musk has done, and if you are a Musk skeptic, you would argue continues to do in building his empire. And if it all works out in the end, we'll view him as a visionary who got humans to Mars and changed transportation and changed the entire world effectively. If it doesn't work out, we're gonna look at him really differently, but it doesn't actually change the underlying behavior. Does that make sense? And so I think if you are somebody who wants to be an entrepreneur, is an entrepreneur, it's sort of you have to be able to embrace that great F. Scott Fitzgerald quote that the true mark of genius is being able to hold two competing notions in your mind at the same time and not go crazy. And you have to be able to hold this notion in your mind that what I'm doing is the most important thing in the world. I am not listening to naysayers. I am forging ahead because my vision is incredibly important. But oh, when that naysayer is right, I'm actually going to listen to them. And I think it's an incredibly difficult act to pull off. You're welcome. I think there was somebody in the middle right there.
What are your thoughts on Jeffrey Skilling collaborating with former Enron executives now that he's out of prison and trying to launch a new venture?
So there was a piece about Jeff Skilling launching a blockchain venture, and if you guys don't read Matt Levine, I love Matt Levine's newsletter, and his take on it was pretty damn funny. Very worth reading. You know what? I think Jeff Skilling is a brilliant man with a lot to offer the world, and he has done his time and paid a huge cost, including the suicide of his son. And arguably, when I say he paid a huge cost, if you look at the fact that Skilling spent 13 years in jail and no executives in the financial crisis were punished at all. And the line between what happened at Enron and what happened in the financial crisis is not black and white. They're both somewhere in the middle. He's paid his price. He's out. If he can create something that's good for the world, that employs people, that moves the world forward, you know what? I'm all for it. I think that might be it. Thank you all so much for coming, and have a great Friday. Bye.
Thank you very much.